Welcome to Money on Tap, your personal finance headquarters. Money on Tap is where we bring out the professionals, experience, and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this radio show. We look at all sides of the issues. We bring a fully independent planning perspective to the table. My name is Seth Krussman, and I'm joined here once again with John Ryder and Ben Brayshaw. Good morning, guys.
Good morning, gentlemen, and I use that word loosely.
Yes, you do, especially when I'm in the room there, Ben, so I appreciate that. Good morning, everybody.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Also, you can find us at Facebook 3D Investing. Where else was I going to go with that, John?
Twitter. Facebook.
Yes. B.
You know it all. MySpace.
G.
MySpace. Isn't that like 2 decades
LLC.
old?
Stands for Brayshaw Financial Group, LLC on Twitter. If you're following us out there, we appreciate you. If you're listening today, thank you for joining us. We're going to dive into a part 2 today. Sometimes that's just what we get to do, right? The topics that we cover in financial planning, frankly, we just got to break it down into bite-sized pieces because they can be an elephant for us to tackle.
Well, Seth, I think that's right on with what we're talking about from last time. We were talking about the big problem of long-term care costs, and you know what? The fact is, it's a huge issue out there. We'll reflect a little bit on that today. But it was such a big issue that we were talking about, and just talking about the numbers and some of the stats behind it. And quite honestly, the truth is, it is certainly a problem. However, there is a solution to it, but we really didn't have time last week to get into the solution, but we're certainly going to spend some time doing that. So Good, because that's what I like to get into here is solution mode. Right.
But before we get into solution mode, we're going to get into fun mode. But that's, we can do both, right?
We can.
Simultaneous. Are you going to be my break? Am I going to be the break? Who's the gas today?
It's going to be me today, man. So here's the deal. We are looking forward to our show today. We have a lot of good things to cover. And I'm really actually glad this week we're actually talking about solutions as opposed to problems, because that's what we like to address when we're working. But sometimes it's important for people to understand, hey, there are some problems out there that we need to identify. And then once we have those identified, let's figure out how to fix them. But before we do anything more, it is time for Money in the News. So,
RESPCT.
Hey, Ben, I am glad to see that. This is good. This is good. So everyone probably, if you're in the sound of my voice here, you have heard the sad news that Aretha Franklin passed away, and it wasn't so long ago, like a few weeks ago, and this is something that, I don't know, Ben, Seth, it wasn't really a shock to me when I saw this headline. It was from Forbes, and the headline was, Aretha Franklin didn't leave a will, so what's next? Why does that always happen? Why?
Well, I would say as always. I mean, that's too general, John.
Okay.
Honestly, but it seems to me that the people who would have the most opportunity to have the resources to find people to solve and cover these issues would be celebrities like her. Yeah.
So this article from Forbes talks about how she died what we call intestate. That means apparently it's without a written will or a trust. And now her heirs are going to embark upon a very public, likely long series of court appearances before the Queen of Souls before it can be settled, her estate. So the experts are basically saying, hey, the biggest issue in these cases are hoping that everything will be amicable among the kids and the family and all that. So I guess she has 4 adult sons. They're getting along, and but the question is that, you're getting along now until it comes down to money. And we've all seen, I think in all of our cases, and I think in our listening audience as well, when it comes to money, sometimes things can change pretty quickly. And things that were looked all smooth and everything before can change very, very quickly. So we're hoping that's not the case there, but
well, there's a couple of things. Like we think that she probably, like you said, Ben, had the resources. Like somebody at some point in her camp was asking her, "Hey, do you have a will?" No. Why? It would be the other question if you don't. But she probably has or had the reasons, whatever they were, not to. That's I mean,
valid reasons.
Why? Yeah, I don't know why. No. I mean, they were hers, so they're whatever they were her reasons. But yeah, you have to think that, okay.
Well, I mean, she's worth like $80 million. You think?
Or she was, yeah.
Yeah, she was.
Yeah.
Maybe she likes to donate to the government. I don't know.
I mean, honestly.
Which is one of the first
I could have
things
found her to write a will. You know, she could have done something off LegalZoom or something like that for $300.
I know. And I think I saw some attorney was saying, hey, we had talked to her about it. We had talked to her about it. She just didn't do anything on it.
Yeah. Yeah, so the first thing
he's got to say that now.
Yeah, is how much of that did go to the will go to the IRS immediately. That's one of the first things that people want to understand is that
at least 40% over 11.2 million.
Yeah,
unbelievable.
Exactly.
Right.
Yeah,
right. That's a lot.
I appreciate her contributing to our tax liabilities and her family.
Yeah, but it is something, and it's always amazing to me, though. I don't know why it is anymore, but it's always amazing to me that someone, as Ben was saying, you know, with the resources and all that, why wouldn't you just take care of it and make sure that your family gets the most of it, or maybe even to a charitable foundation. Maybe you don't like your family, but maybe to a charitable foundation that you do like or that you've grown to appreciate over the years.
Yeah, I mean, not even to have a will. I mean, you know, you could get into tens of thousands of dollars of complex trusts, and I mean, she could have really had to, you know, do it up to avoid taxes for the family and so forth. But honestly, to put people through, you know, this type of situation as family is really a tough deal. A will alone would have solved a lot of issues.
Well, here's what they're saying. They say that she was a very, very private person, extremely private. And so now that's all going out the window, because what's going to happen right now is there's going to be a public filing, so all of her assets are going to be on the public record. And so we're going to learn more about her than probably she would have ever wanted anyone to know.
Yeah.
In that whole thing. So it just, you know, being proactive and planning there makes a whole lot of sense.
You know, I mean, for, you know, a few $1,000s at most, I mean, she could have completely kept her entire life private. Yeah. Everything about it. She could have a simple will, a pour over will to a simple living trust, and it would have just been so easy. I mean, it's just silly. I just wonder if the legal side of this thing was trying to sell her up on a big shooting match, and she just couldn't decide.
Yeah, she was just didn't want to hear it. The thing is, too, what with the way that she earned her money, she has these different songs that plays and that get royalties and all that. So this is money that's going to go on and on for years and years. And I'm sure.
Well, I know we should be playing that respect song a little bit more.
RESPECT, yeah. So that was story number one in the news. The second story that we're going to talk a little bit about today, and I thought this was pretty interesting, guys. I saw this a couple of weeks ago, but Fidelity just recently reported that the number of 401k millionaires that they have on record has hit a record high, meaning that people are saving. The market has obviously been doing well, and there's a record number of new investors there that are actually 401k millionaires, not even counting their other assets, but just their 401ks.
Well, it's just interesting because, you know, the S&P 500 has done very, very well over this last year and a few years. And, you know, when you look at some of the performers, it's not like, you know, you talk about the S&P 500, you got 500 companies in there that are being, you know, monitored and so forth. But it's only like less than 10 that are the vast majority of all the performance. And
they're driving everything else. But it's such significant performance. And then you got the S&P 500 indexes and so forth that people are tracking in their various funds. And they're seeing unbelievable returns, and it's been great. I mean, it's really been great. There's a VP at Fidelity that was talking. Her name is Jean Thompson. And so she's a senior VP at Fidelity. And she was saying that individuals are actually increasing their savings rates. They're taking advantage of their company match, and they're keeping a healthy percentage of stocks in their account. And she went on to comment, it takes many years of consistent savings and investing, but following these steps as part of a long-term retirement strategy can put an individual in a good position to eventually reach this savings milestone. I love that free match that she was talking about, that match. And a lot of times we find that sometimes we talk to people and they're not taking advantage of that. So we always encourage people to go ahead and take that free money. You know, that was something that was never involved in the past. You know, we've always talked about pensions were a big deal in the past, where the employer was contributing for you. Well, the employer will still contribute for you. You might not have a pension, but they will still, many times, in many cases, will offer a match if things are looking good for the company. So
I think one thing that, you know, we're talking to a lot of people about today, and I know this is a little off topic, but, you know, with the tech industry having such a big boom recently in the various performances that people are seeing, diversification is really, really important because some people are starting to lean heavier and heavier onto that side. At least people I've met with and talking to and so forth. And I'm chatting with them saying, listen, you still need to be diversified. Even though you see performance in that area, it doesn't go up forever, and people have such short-term memories on the market.
I can't agree with you more on that. One of the things that we're doing, and we're being very careful with our client portfolios, is making sure that we're not all chasing after several different stocks out there, and we want to make sure that the portfolio is well diversified. In the very likely event that at some point in probably the not too distant future, we may see some corrections in there. So we want to be very, very careful with that. And these 401k millionaires that we have, if they have $1 million in there and they're all sitting in high risk stocks, well, we all know that very quickly that $1 million can turn into 700,000, right?
Yeah.
Or even less if we look back at 2008.
A few of the things that I like seeing here in the article was that the average balances are rising.
Yeah.
6.4% from last year's second quarter. And that, what was that? From the final quarter of 2017, the average IRA jumped up 7%. So those increases are really nice to see. And part of that certainly is a market dependent aspect of it. But then some of the other things I think that are great to see that contribute here is the borrowing from the 401ks has started to drop.
Yes.
And that there's been auto enrollment gains. And for those of you that are the business owners out there that have the 401ks for themselves and for their employees, that's one of the first things that I like to recommend people take a look at taking advantage of. It can drop is an auto enroll for themselves and for the employees. And what that means is that those employees can opt out at any time of that auto enroll, so they don't have to participate. But it's a tool that really gets people in the game, because a lot of the time people aren't going to make a decision for themselves. So if the decisions are being made kind of for them, with their ability to step back and not participate if they want to, that's the one thing some people get a little confused around, is that they're not forced to do this, but it just happens automatically, as well as some of those increases. So it can really develop a kind of a habit in the background for them with their finances that they're not really even aware of. And
it's a decision they don't have to make, right? Seth, it's a decision they don't have to make, because if they have that auto draft coming out the first of every month or every paycheck or whatever, it just automatically happens. The problem is when you're
simultaneous to that, I want to say to you that can also lower the cost of the plan a little bit. Every dollar counts. Savings counts, and we like to make sure people are at least aware that they can take advantage of those type of opportunities.
Absolutely, right on.
I think one of the things that's in the 401k space that's really interesting. I was talking to one client a while back, and she was telling me that when she got her first job, she was eligible for a 401k, and she instantly started putting money way into it. There was no match, but she always felt like that was my first job, and I had never really had paychecks before, so anything more than zero was a win. So she just kept doing it and doing it and doing it, and she's become very wealthy over the years, and she's far from retirement. And those are types of disciplines that are a little bit of a lost art, and we don't realize how
consistency, right?
Yeah, you don't realize how quickly that stuff does climb, and
it's almost kind of like the inverse of, if you think about how people get into credit card debt. You know how some people have a credit card, and all of a sudden they put $50, $100 on it, and it's very, very easy to start doing that, and all of a sudden, boy, it accumulates fast, that debt, and all of a sudden the interest on that accumulates fast as well. So I think Seth, we were talking one time. Was it your dad that was saying something about getting on the right side of compound interest? Your dad talked to you a lot about compound interest as a kid, as I recall.
Yeah, we did a show recently, kind of on it was in family finances. I think we were talking a little bit about how did we learn. And my dad was, the rule of 72 and explaining that to me and showing me the Roth IRA. And if you max that contribution out by the time you're, 30 or 35, you're a billionaire, right?
Yeah.
And of course, me being 15, it's like, whatever. Is there a skateboard involved in there somewhere? Okay.
No, you can't afford it. Save the money.
Yeah.
I don't like that idea, Dad. I want my skateboard and I'm going to do that. Yeah.
Yeah.
Well, when you start thinking about auto saving and, less loans and all the different pieces that are going on here, and just even the repatriation of funds that we've talked about in the past, and some of the tax benefits we've seen in the tax cuts, there's a lot of money that's getting pushed back into the stock market for that, which creates more of a foundation, more of a base for the underlying values. Like I think about a lot of the repatriation funds that have happened and the stock buybacks we're seeing. Those types of things are increasing strength inside our stock market, and that's exciting. That's a very good sign for us long term. Now, I mean, there's obviously a lot of other concerns that are happening, and we have our fears and woes and concerns as we're listening to this, I'm sure. But there's been a lot of hype that the stock market has been oversold, growing too quickly. But you have to see value coming into something. It's kind of like, eventually it's like the car that, it's the antique car that's just being sold for millions of dollars. Eventually it's going to rust away, right? I mean, there's nothing really, nothing pouring back into that vehicle unless someone's doing something to it. Well, the market is doing something to itself. If people are putting more and more money in there, it creates that strength, that stability we're looking for, that foundation. The repatriation funds and the buyback of stock that's happening heavily along a lot of companies is huge. I mean, that is just an enormous benefit for our stock market. So,
yeah, interesting idea there, because there's the pullback that's bound to happen. We talk about that. It's going to be somewhere around 50% historically is what we're going to experience as a pullback in our market. But a 50% of, let's say, 100 is 50, right?
I got you on that, Seth. I got it.
Yeah. Okay, good. Because the next math I'm just going to skip on through here. As it goes higher, 100 plus, right? The 50% becomes 60 or 75, sure. Or so on and so forth. So that base continues to increase the more that the market rises, and we talk about that as well. Hey, you know what? That's going to do it for us at Money in the News. We'll be right back. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com.
Hi, my name is Seth Krussman, partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. One of the biggest concerns and largest expenses people face today is taxes. Without thoughtful planning, taxes can destroy future retirement dollars, eliminating the possibility of a timely retirement or dreams of what you want retirement to look like. If you're like most people, you're getting closer and closer to retirement, and you may be wondering if you're taking the right steps. Will my income be enough? Will rising taxes force me to give up my dreams? How does inflation factor into all of this? These are real concerns, and you're not alone. Putting a plan around your financial future is what we do. If you have questions when it comes to your financial security, and if you're looking for a personalized solution, contact us at Brayshaw Financial Group, 855-226-8551. It's time for you to start getting answers to your questions. Headquartered in Bedford, New Hampshire, Brayshaw Financial has offices across the country. We'd love the opportunity to show you how we can help. There's absolutely no cost or obligation to meet with us. Call us at 855-226-8551. 855-226-8551.
Now back to Money on Tap with Ben Brayshaw, John Ryder, and Seth Krussman.
Welcome back. You're listening to Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do here on this radio show. And we're glad you're joining us today. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Today, we have just kind of gotten through that Money in the News bit. That was fun. And 401k plans are stacking up, and that's fantastic. That's all good news. But today we're going to actually talk about ways that you can protect those dollars that you've been increasing and saving and growing, as well as protect you, our listeners, from losing your portfolio in really an aspect of financial planning that can have ravaging effects. And that is paying for long-term care. Yeah,
it's one of those expenses that many of us want to ignore.
I thought you were going to say look forward to.
No. But it's one of these expenses that, financial planners try to do a great job of building their clients' portfolios, and they do their very, very best. We were just talking earlier about just different strategies that we use, and we spend a lot of time in strategy when it comes to the different portfolios that we select, and we'll use annuities to help protect the downsides. We'll use different types of portfolios to help mitigate some of the risk. However, one of the major risks that people avoid, or that people even avoid talking about, because no one wants to talk about it, but the fact is, if you have a decent-sized portfolio, and decent may mean whatever that you've saved over the years, and if you have not taken a look, if you're age 50 or over, and you are not taking a look at what can happen to that portfolio because of long-term healthcare costs, then it's something you really need to reevaluate. Last week we were talking, and I think we just touched on it briefly, about the Titanic. Going through the water, had no idea that the icebergs were out there. And many of us, we may have portfolios that have done pretty well. And we're just talking about 401k record-setting time right now. We may have portfolios that are doing very, very well, and we don't have a whole lot of cares in the world right now. I think we're going to be okay. We got this retirement thing. Yeah, maybe I'm not going to have quite as much money as I'd like, but we're going to be all right. But one of the things that many, many people are not really paying attention to is the fact that there are icebergs out there in your future. The question is, are you going to be able to navigate around those? And we don't really know. When the Titanic set off a long time ago, back in 1912, it had no idea that it was going to face some serious ramifications just in a short time later.
Or that it was going to be a fantastic film later on, where that's all what I have is the theme song from the Titanic in my head now,
yes,
John. Thanks.
Yes.
And anyways, yeah, it was good. Please, somebody else take over.
Okay, so I was just going to say, and I'm trying to not think of the film as well. So
it's a good film.
But when you talk about icebergs, we talk about Titanic and using that kind of imagery here inside the fear-based scenario. It's not like there's one iceberg.
Yeah, it could be several
I think long-term care is just one of many icebergs in your portfolio. I mean, there's other icebergs. And the icebergs could be, a next war or a nuclear bomb going
economic
off.
Collapse.
Economic collapse in some European country, or China doesn't buy our bonds, or there's a number of different icebergs out there, and some of them you don't even realize are there. Matter of fact, you can't even see the iceberg itself, nevertheless what's underneath the water.
Yeah.
And it just happens, and you're just a victim of it. You may not even think you're on that path. And I think it's naive for us to say, that that's not going to happen to me. This is not going to be an issue for me. There are so many potential global events that can occur separate from your own health that can change your entire forecasted future. And that's something that you need to navigate. We talk to people all the time. It's not how much you make, it's how much you don't lose.
Yeah.
And, it's great that the markets are up. It's great that we're all seeing some gains. But honestly, when the market pulls back, what is stopping you from falling and free falling essentially at a terminal velocity and having another 2008? Those types of things are real issues. But when it comes to long-term care, this is something that there's enough foreshadowing. There's enough historical data, and there's enough relevancy to everyone's potential need for this. Just on the percentages, it's so high. It's like over 50% or something like that people need long-term care potentially on some. And when we talk about long-term care, most people hear nursing home.
Yeah.
And we're not talking nursing home. No. We're talking about care in your end stages of life. Like, as you're, just in walking, bathing, eating, just the general principles of life that just slowly slip away from us. And as sad and as unfun as it is to talk about these things, it is still something that has all the presence of an iceberg. And the truth is we know how big this iceberg could be for some people.
Yeah.
So, which iceberg you're going to hit, we don't know. Now, preparing for this one, knowing that you can prepare for this and deal with the other ones separately as they come along, makes it a little bit easier to deal with it, knowing that you have some protections in place. And I think that's what we want to talk about today.
Sure. And what I want to do is we mentioned the Titanic, and I want to really highlight that a little bit because I do believe that the analogy here makes a lot of sense when you think about the Titanic, and this was taking off in April of 1912, a long time ago. But this time, when this was built, this was the most luxurious ocean liner ever built. In fact, engineers that built the thing were saying this thing's unsinkable. You think about that. It's kind of unthinkable for them to say it was unsinkable. But the fact is, it was a huge ship, the largest one ever built, and they thought nothing can ever happen.
The compartmental construction of it as well was kind of what they refer back to, where those they really thought that it was going to be able to stop any kind of a hole being punctured in it, but there wasn't a plan for that rip or that tear that went across multiple compartments. And so the engineering, they just didn't think of that.
Yeah.
You know, that wasn't what they were setting this up for. But it was, you're right, it was a lot of hype around that.
But if you remember the movie, I know we don't remember from our personal experience, remembering reading about it in the papers or whatever, but if you remember...
let's take the historical facts from the movie, John. Come on.
So with the movie, though, just remember, this was, again, there were bands on board. This was an exciting time. This was for people that had money, people that were very, very wealthy, that were able to afford this maiden voyage.
Or not, that were not up where the bands were. There was that class, because I'm going to go into the movie mode, where there was the class separation, right?
Yeah,
there was the lower deck, and then there was the upper deck.
But if they're on that boat, they had some means and all.
Yeah.
There's certainly, I'm sure there was a class warfare back then as well too. Yeah. But the fact is, they carried off 2,224 passengers and crew were on board, but they only had lifeboats for about half that. 1,514 people died. This was a human disaster on a colossal scale that none of us can really even, it's hard to even imagine today. But it's also a story with strong links to insurance coverage, believe it or not, because the Titanic was actually insured by a company called Lloyd's of London, which I'm sure you've probably heard of before. But basically what they did is they had insurance on this boat when they took it out, when the Titanic was taken out. Obviously a huge thing to have insurance on. I'm sure the premiums were high. However, they weren't really paying premiums for that long, because the maiden voyage, this boat goes down. You know what's interesting, guys, as I was doing some reading on this and some research, the boat here actually, went down pretty quick. But there was newspaper reports there's conflicting reports. Some were saying that it sunk. Other newspapers were reporting 2 days later that the Titanic had survived and was being towed towards Halifax, which was obviously not the truth at all. But Lloyd's of London, the underwriters, they covered this, and they covered it well. In fact, it says here in the publication that I'm reading here that within a month, that the claims had been paid, despite all of the tragedy that ensued. And think about that. Think about all these families that lost family members. Think about this ship, huge ship, and think about how insurance worked there. And in some cases, I make the analogy, having some insurance in place can make a big difference for people, whether it be personally or whether it be a corporate type of insurance. But having insurance can actually make a huge, huge difference in people's lives, and it certainly helped here.
Mm-hmm. So before we get into subject matter today, just want to help people understand that the three of us here, we're not elder care attorneys. So when it comes to your planning, we want to deal with a licensed professional who's qualified to give you the advice you need. But simultaneous, we work hand in hand in the solutions that really are being brought to the table to help minimize the effects of long-term care and the costs that maybe coming down the road through that process. So just a little disclosure there, folks.
Absolutely. Just the other day I got a phone call from an estate planning attorney who's working with one of our clients, and she was just a really wonderful lady, and she was just saying, hey, listen, I want to let you know that we took care of all the estate planning and for your clients here, and I'm just going to have my paralegal send along to you the instructions as far as how the assets should be titled, how the ownership should be labeled, as well as how the beneficiaries should be labeled. And I love an attorney that does that actually follows up, because a lot of times people go ahead and get different estate planning documents done, but the problem is many times they never follow through and actually make the beneficiary changes. So it's kind of a pain in the neck if you haven't done this before, but if you have an estate plan done and you have an attorney that gives you a lot of different instructions, there's a lot of different places to go. The first place might be to your bank to maybe have assets correctly titled. Then you might want to go to your financial advisor. You'll go to your life insurance company. Sometimes they're one and the same. But you want to make sure you take all those steps following the great steps that have been outlined for you. Because many times, and I know, Ben, you've seen this before, when estate planning gets done and there's never any titling done. They have this document written, but if you're not actually taking a proactive step and actually doing the work that needs to be done after that, then that can actually be a problem. And we see that happen sometimes. So as Seth mentioned earlier, we are not estate planners. However, we do work hand in hand with them quite often in order to minimize and to mitigate the estate planning tax that people can be paying later on. So today, let's focus on some different ways in which we can protect assets from nursing home costs. And there's several different ways. And again, this is maybe not a fun topic for many people, but I think it's very important just to get a clear understanding. There are different ways that you can have some long-term care costs in the future. The question is, how are those going to be paid for? That's really what we're talking about today, is how do we fund those long-term care costs?
Yeah.
And some people say, I think, Ben, one of the most common things I see, and Seth, I know you've seen it too, is when you're sitting down, you're talking about these issues, you're talking about those icebergs, people say, well, you know what? Well, the good thing I have Medicare, so that will all be taken care of. Or on the flip side, they might say, well, you know what? Medicaid is going to take care of me. And many times, I think we even talked about this last time, people don't understand the difference between Medicare and Medicaid. But Medicare is certainly something that can help cover. However, let's talk a little bit more about that.
Yeah, I mean, it only covers the maximum of 100 days, that actually could end sooner than 100 days. You're not guaranteed 100. It's usually based on whether or not you can progress towards further health or wellness, meaning that you're improving and you're continuing to get care because it will make your life better and you're getting closer to caring for yourself. Any point in time that you're deemed as you've kind of reached the peak and additional care will not further your condition, your improvement, and it's less than 100 days, they could stop in 10 days, they could stop in 98, 99, or 100 days. But Medicare and Medicaid are mixed up all the time when we talk to people.
I wish the government had a long time ago talked about making it different labels, because they sound so close, don't they?
Yeah.
And I think we talk to people that are 65 retiring and they need to go sign up for Medicare supplement policy. They have no idea they might say something, well, I need my Medicaid policy taken care of, and it's just something that people aren't familiar with, and I think it's just they're too close in sound there. But
yeah,
they're very different. So Medicare is basically helping for the first 100 days, but the problem is, let's say that you did need care in a nursing facility. Medicare doesn't even pay for that. And at a maximum, and only after meeting certain qualifications, Medicare may pay up to 100 days in a nursing home as possible. But
yeah. And I think the thing is Medicaid, we'll get into that a little bit, but Medicaid is really a different type of planning. I mean, that's really, based on, kind of the conversation we're having here to talk about how long-term care insurance has changed and kind of some of the things that are going on there. When you talk about Medicaid planning, it's something we can chat a little bit about, but I think, as we're kind of going through this, Medicaid planning is for somebody who's like, you know what, I'm kind of giving up.
yeah,
I don't qualify for long-term care insurance, or I didn't do anything about it when I could afford it, and now I just need to do something clever to protect as much as I can for my healthy spouse or my kids or whatever that is. And we've done a lot of work in those capacities over the years, and it's kind of a give up.
It is kind of depressing when you think about it, because they kind of figure, I'm just going to go through my assets, and I'm just going to, I'm not going to have much left, and I'm basically going to end up being taken care of by the government, basically.
Right.
And so not really an enviable place to be. Not that some of us might not end up in that situation, but there are certain ways around it that we can.
And there's
look at.
definitely some people who are strategizing to do that intentionally. Like they're like, this is the life we have, and we've set it up, and they've done some very clever planning, and they're like, we're just going to let this ride out, and we'll both be fine. And with some expensive planning, you can do that at times. So one of the main ways that we're going to talk about just a minute here before we take a break, but one of the main ways that we help folks deal with the issues of long-term care costs is to look at, well, how can I insure that? Just like the Titanic was insured, there are different ways that you can insure your future when it comes to long-term care costs. So we'll come back and talk with that in just a minute.
You're listening to Money on Tap. We're going to take a quick break. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com.
On this edition of Money on Tap, a runner alone in a long-distance relay race. That's how Ben Brayshaw describes the feelings of many people who are dealing with investments and retirement.
usually no one really around you, and you're running by yourself, and it's like 6-8 miles. You're waiting for the big marker to come up to point you to go a different direction. You're like, am I on the right road? Am I going the right direction? It's all dark around me, and I'm not sure. I'm alone in this space. Yeah, this is how a lot of people feel in this world about their investments and their retirement. They feel like they're running on a pitch black road. They think they're going in the right direction. They're pretty sure. They're not exactly aware of where to stop and ask for help. This is where people like us come alongside, and we bring a lot of light with us. When you have a planner, you have someone, like in the conversation I had today, it's bringing all those pieces together, because you have this 401k or whatever retirement plan you have at work, then you have your home, and then you have some other assets outside of that. You're basically trying to funnel that all into this one item called retirement. And I think ultimately most planners, most firms just look at the assets outside your home and outside your 401k, and those are the two largest assets.
Sure.
So how can you really do planning when all you're looking at is just a small picture of what's really going on? And we have to have a holistic viewpoint, and we need to really break in to getting you to have a successful retirement event, whether it's at 35, whether it's at 45, 55, or 65, whatever that time period is. That's where you have to have your trajectory set and ready to go and get the help.
Stay that course.
Yeah.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning.
Welcome back. You're listening to Money on Tap, your personal finance headquarters. You can reach us at 855-226-8551, or you can email us at info@yourmoneyontap.com. Options. That's what we're going to talk about here, because we're going to go actually into options of what is the long-term care solution here.
Yeah, so we were just talking about insurance and how that can certainly be a part of someone's plan. Years ago, guys, insurance companies started to get smart. They used to sell disability insurance, they used to sell life insurance, and all of a sudden they kind of realized, wow, we have some issues here. No longer do we have families taking care of each other all the time up until the very end. We have families that are geographically diverse. They're all over the country, so you don't live all in the same neighborhood. You don't have mom downstairs and in the basement and all this. Everything has changed when it comes to that. And so insurance companies kind of got a wind of that, and they decided, there's probably some opportunities for us to make some money here as far as working with people, helping people to protect the fortunes that they've saved over the years. So one of the main things that happened, this is probably about 20 to 30 years ago, they started offering something called long-term care insurance. Long-term care insurance was something where actually people would pay a premium in every single month, and they would understand. It could be annually, they pay for it, or yearly, or monthly. But the fact is, they'd pay it on a regular basis. Now, if something were to happen to them where they actually needed long-term care in some capacity, in the beginning, it only covered facilities, so you could only go to a nursing home, but it actually expanded a little bit later on where you could actually have home health care. In fact, it was required by law to have home health care.
It was funny because they used to say it was only in a nursing home, and they thought that was a great exclusion. Yeah, but then the insurance companies figured out it's cheaper for us to actually care for somebody at home.
Yeah.
So why don't we offer that? And then the states did require it at one point because it was a big issue.
Yeah. So listen, these long-term care insurance policies were actually pretty vogue and very much in style back in the day. In fact, a lot of people were utilizing them as they started to understand the problem of long-term care in the future. The problem with a lot of these long-term care policies is the fact that you had some people that had very negative experiences with them. So they'd go to make a claim, and the insurance companies made it every way to Sunday in order to be able to get the premium, the actual benefits paid.
Right, and there was actually where law, governments did step in, did enforce certain things and found them to be unfair and so forth. But I think, what's interesting is, I don't know about you, John. I've not been a big, long-term care has not been a big portion of my practice over all the years that I've done planning. It's a conversation and so forth. I've met a lot of people who have already purchased it from a third party because they got some mailing thing and so forth. What I found in the conversation with most people about long-term care, it was like, well, I don't want to spend all this money on this care policy that honestly I'm going to be dying in the process of and staying in some nasty, smelly nursing home that
Have you ever gone to visit a grandfather or great-grandfather? It's very depressing.
And I don't want to spend all this money on this kind of end-of-life stage thing. I'd rather just die, and in my sleep and so forth. And and honestly, if I don't use it, I'm going to lose all this money.
Yeah.
And I've been living off my Social Security and pension and a little bit of retirement funds, and I never planned on this additional expense.
And Ben, their excuse was really quite valid in a lot of ways, because sometimes people would never use it. There'd be so many stipulations where they couldn't. But another factor that we found over the years was the fact that this insurance coverage might have seemed pretty affordable up front. right? So they'd pay their premium. But one thing that the insurance companies knew was the fact that, we're not quite sure what's going to happen with long-term care expenses down the road. We can make some forecasts, and maybe $100 a day will be sufficient. We'll give you some compounding with the benefit over time. But the fact is, they left it open that they could actually go in and raise rates on policyholders later on, not individually. So
meaning how much the person who purchased it was going to pay every month or year.
Now the insurance
to go up at any point.
Exactly, the insurance company couldn't go in and say, "Well, Seth Krussman, because of some things that I'm seeing from a health standpoint, I'm going to raise your rate specifically." No, they couldn't do that. But what they had to do is they had to petition the state government there to actually say, "Well, people in Portland, Oregon, that are between the ages of 67 and 77, we want to raise the rates 5% or 7%. And the states would allow them to do that. And here is what we have seen across the country. These rates have skyrocketed. So you have large companies out there that are very financially savvy, Genworth, John Hancock, that were having to raise rates. In fact, I just saw something from Genworth coming out, 58% rise in premiums for their clients. And that's on top of a rise that happened earlier. So these companies all that started out saying, hey, this coverage is going to cost you this much, but we could raise it, are raising it, and they're raising it in record fashion. And that is very cost prohibitive for people that are living on fixed incomes.
Right. And I think, what has been the biggest kick in the teeth for people who bought long-term care, like the traditional long-term care policy, the one where you just pay a premium. And you could buy a return of premium rider, which meant like everything you paid in, if you never used it, could come back to you. Yeah. But if you used $1,
done.
You're done. You don't get that money back. And what the biggest kick in the teeth was that when people came down to it, everyone's living on a budget on some level. Mm-hmm. And they would come back to you and say, all right, your rate's going to go up X dollars per year. But we'll give you an out to keep your policy costs the same by lowering your benefits or taking this off or taking that off. I mean, just basically, it's like if you bought a car and you said, "Hey, I can't afford this thing."
Get rid of the roof.
Let's say you bought a car. Let's say you bought a car and you had this monthly payment, and they came back to you and said, "Listen, your payment's going to go up." Or we can remove the power windows. We can take out the air conditioning. We can take all these things off that you purchased to begin with and you've been paying for, and to keep your price the same. Or you can pay our new price that we've come up with. And it's just, it really has done a number on, like people caring for this stuff. And then that's led to more Medicaid planning, in my opinion. Now, this is where the world has changed. A lot of insurance companies have mispriced this stuff so heavily.
They have. I mean, across the board. In fact, everyone's out of the business now, Ben.
Well, not everybody, but they're on their. If they're not out, they're on their way out.
They're on their way out.
Traditional long-term care is becoming a dinosaur.
Yeah.
And what happened was, and what I have been told, or the insurance information has kind of passed through the channels on my end, is that when they priced this stuff, they priced it on, the insurance companies have all these actuaries doing all this work and all these numbers crunching, and they have a ton of information in history on how long people live and die. Now, they've been collecting information on how long people get care and the statistical numbers on that and so forth. But what they did was they priced this thing on what I understood to be a term life insurance chassis, which we all understand kind of generically that term is the cheapest insurance. It's not permanent. And they expected people, a number of people, to just die in their sleep and it's, want to stay home. And that's why they didn't provide at-home care at first.
Right.
They didn't think people would want to go. And that, people would actually just forfeit their policies at some point too.
Yeah, they walk away.
Yeah, just walk away. And that never happened. What they found is that they became more sticky, or they stayed in force better than most insurance policies across the board. So then what they've done is they've moved it over to a whole life kind of, or a permanent version of insurance, chassis. Yep. And this is where the hybrid story came in, which has become tremendously attractive to a lot of clients.
This has changed really the landscape of the long-term care era here. Because if you think about this, if you had a grandmother, Ben, that experienced a bad time with long-term care insurance and she complained about it, that long-term care insurance was the worst thing I ever got. And some people actually felt that way. Now,
I've heard that.
Yeah,
I've heard that.
On the flip side, I've actually had clients where it's actually worked out very well for them. In fact, I'm in the middle of a situation right now which we're helping to pay benefit out for our client from a traditional long-term care policy. It's going to work out very, very well for them. And I'm really glad, as 18 years ago, that they had this product, and it's going to work out very well. But on the flip side, there's many people, and I've heard many people say, I had this long-term care policy. I paid in for years, and it never paid me a benefit. The insurance company figured out how not to allow me to use it. But Ben, you just mentioned something, and that word I think is pretty important here. The new type of policy out there that they're talking about, and this is making a lot of sense, is called a hybrid long-term care life insurance policy. Powerful.
One of the things that I've seen as far as a trend in the type of coverage and the policy and the delivery of these has been, the people that I'm sitting down with and talking to about what kind of coverage do they have in this area. Most of the time, the coverage has come through a property and casualty type of a company. You name it out there, your State Farm, your Allstate, the USAA, or any of those big players. And either they've got the introduction through the mail, as most people have that type of service or have had that, or the agent has sat down. As a matter of fact, a friend of mine that's in that industry, their passion is around the long-term care planning solution because of the personal experience they had with their grandmother and seeing how the estate really just got destroyed through the long-term lack of long-term care planning in their family. But the thing that I wanted to come back here that we're gonna get into some solutions, or what are some options is the advantage of being the independent here, of having the channel to be able to go and take a look at the entire industry, not necessarily what the larger company is just making available, because they're not making available what the entire industry has set aside for that client. And being able to take a look at what are the options and the flexibility and the different modes, and understanding those types of coverages. And I think that's where we're heading right now. But I just wanted to just share that experience with you folks. If you're in that situation, if you have seen those types of those policies come through, have a second look. Have another set of eyes that has the options and the ability to really take the vastness of this industry and bring it to the table in a way that can provide the solutions.
So we were chatting about some of the hybrid stuff, and I think there's a lot of people listening today that are saying, I don't even think I qualify for long-term care.
Right.
So, we have there's basically two.
Do you mean because of health issues, or because of age? They're too young or too old? Or?
Either they're too old, they're older. Maybe they might be healthy, older, but it's too expensive.
Yeah.
Or because they're unhealthy and they can't qualify for it. So there's a couple things. The first piece that's changed is the hybrid life insurance chassis, which has provided people a lot of different. And there's so many different companies out there starting to offer this stuff. You got to be careful. I mean, there really is some planning and some foresight before just going to buy something. You really need to understand what you're purchasing, and we say that constantly. But I mean, you can actually get something that turns into a life insurance to a spouse if you don't use some of it or all of it, or maybe a life insurance vehicle that would turn into something for your kids. But it provides for your long-term care, and it can provide for yourself, for both you and your spouse. It can provide for a certain period of time. It can provide for a lifetime. We have done so much of joint life coverage in this stuff, which has been fantastic. And what's nice about this is because it's on a whole life or a permanent kind of life insurance chassis, the price is fixed. It can't go up. That's big. Problem A is solved.
Yeah.
That's the biggest complaint about the long-term care policies in the traditional world.
Right. And we were talking about the Genworth publication. It's a rate increase of about 50%. So whatever that long-term care policy is that you've been paying for, I mean, darn near double it. That's what you're going to look at.
Yeah, and you can actually choose. I mean, honestly, you can choose like how long you want to pay for this. I've had people who are in their 50s or 60s say, I just want to pay for 10 years.
10-year pay.
I'm going to struggle through this, get this over with, and then I'll consider it a raise when I don't have to pay for it anymore when I'm 65 or 70 or 75 or whatever that time period is. That's actually a really clever way of doing it for a lot of people.
I like also the just moving some assets off the table, like a single pay type of an option where, it's an automatic almost double of the coverage or the amount of dollars that you put over into those policies.
Depending on your age and health, absolutely.
Oh, okay, guys. So we're talking all about how we're paying for it. But Ben, explain how a hybrid policy works. Okay, so you said it's off of a life insurance deal. So what do you mean? Is it life or is it long-term care? You said it's both?
Right. It's this thing. It's both. It's kind of like a car that can fly.
Okay, so you buy a life insurance policy, and let's say the life insurance policy was for $200,000, right? So let's say that you have your policy in place for 5-10 years, and all of a sudden you need a long-term care.
Yeah, they would convert a portion of that life insurance policy.
Okay.
So if it's $200,000, they might say, all right, well, we'll use 150 or whatever percentage that is that you've signed up for towards a long-term care claim. and based on some proportionate value. So like, let's say you use 50% of your long-term care, there might be 50% of the death benefit left over for your family.
Okay, and then if you need to use 75%, you can. And if it ends up that you need to use all of it, then that basically means, well, there'll be no more life component to it, but it'll just be all used for long-term care. So the fact is, let's say that either way, let's say that you go through, you buy this hybrid policy, and you have it for years. You have zero issues with long-term care. In fact, you're just like your grandfather before you. You don't need any coverage. And he was 87 years old and died in his sleep. If that happened to you,
he was working on the engine the night before and passed away. You know,
So in that case, there'd be no long-term care coverage at all. None. Well, there's coverage, but never got utilized. But then when he passed away, then
the death benefit
would go to the family. Okay.
Well, yeah,
that death benefit can be substantially more than the dollars that are put in. That's typically what I've seen too.
Yeah, and you can also buy these. You can buy these enhancements. They call them riders.
Yep.
That you can extend. Like if you happen to go past your percentage of dollars, that they'll continue it for a period of time, either additional years or even up to a lifetime. Or depending on how you apply for it, it could be for a husband and wife jointly forever. So, I mean, it can get pretty advanced, and that sounds expensive, but, I mean, honestly, it's pretty interesting how it seems to work out for a lot of people. I mean, I don't find it excessively expensive compared to traditional long-term care insurance, but now the prices are locked in.
That's the big difference.
That's huge.
Ben, we were talking about that. You were talking about how the underwriters and all that, they didn't really plan well for the increase in cost. But I think also, too, even in the underwriters on this, think about what has happened with long-term care costs. It's like the college costs. They've gone up like crazy. And you look at the technology, and people are living longer and longer, and medications are better and better, but it's causing people to live longer and longer, more comfortably. But they had no idea. They had no idea what this was actually going to cost. They knew it was going to be a lot, but they had no clue of how much.
The other thing is, it depends on how your planner's working with you, right? So some people are trying to plan for the entire cost of long-term care. And honestly, when one person goes into care, the entire family expenses usually are reduced anyways, because you're not going out to dinner, you're not traveling as much as, there's things that are being, money's not being spent on. You can usually take a portion or a percentage of assets and say, all right, this is our income. We can allocate this percentage plus this long-term care policy probably to care for each other. And if you both go to a care facility, then you're not going to have household expenses anymore. Now, there's another side of this thing that's really interesting is for the uninsurable person.
Okay.
Now, I had a client who could not qualify for long-term care. We had tried, and
meaning you went to underwriting and tried to get through and
couldn't get it, so forth. And what we did was we were able to take a portion of his assets, and we were able to buy this hybrid annuity long-term care.
Okay,
product.
so this is something different.
Exactly.
Yeah, okay.
It has nothing to do with life insurance.
Okay.
It was literally an annuity that had a rider or an enhancement that provided for some sort of long-term care supplement. Now, every company's different, and they have all different types of pieces inside this and what it does and how long it will provide for something. And it's not a not a tourniquet to a problem.
Yeah.
It's a Band-Aid.
Yeah.
It's a helping hand. It's usually to enhance the assets you have so that you spend down less to try to preserve assets for the family. So but it's not like if you're sitting here saying, I don't qualify for long-term care, there may be solutions to solve your problem depending on your asset base and what you're doing and how things are allocated and so forth, because he was able to transition from one asset to another, provide for income the way he was, and then there was an enhancement to provide him excess dollars above and beyond over a faster period of time should he go into a care facility.
Wow, so there is definitely some planning here. As we look at it, we're kind of summarizing the different coverages out there. Well, the first thing we're talking about is, well, if you need long-term care, Medicare can be a solution just for a short amount of time, perhaps. Secondly, if you really don't have any assets to protect and you're basically looking at just kind of spending down, well, Medicaid planning is what we often will recommend that people do. But on the flip side of things, if you do have assets to protect that you want to be able to pass on to your spouse, that you want to be able to pass on to your family, well, there's different ways to look at ensuring that as well. That could be through a traditional long-term care policy, although we're not seeing many of those out there right now. It could be through a hybrid life policy that would provide a death benefit as well as a benefit to pay for long-term care if needed. But also, just as Ben was mentioning here, there could be something called a hybrid annuity, which would allow folks to be able to take care of some long-term care costs that way. So there really are a lot of different options. And I think really the thing that we'd encourage you to do is if you haven't explored those options before, if you've just realized, well, there is a problem that could happen, there is an iceberg that could be in my future, then perhaps it's time to start looking at solutions to that and ways in which you can help help take care of those costs later on. So let's, if you haven't given us a call already, we'd really encourage you to give us a call, and we'd love to be able to discuss those solutions with you and help you protect the assets that you've worked so hard for over the years.
Hope we've been able to answer some questions that you might have, or start a conversation, or at least start thinking about ways in which you can protect what you have saved over the years. That's going to do it for us here at Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.